What's up, you guys? Sean here at Options Pro Trading. And with everything going on in the market right now, we have some instability, we have some volatility, we have some very popular stocks that are currently in pullback, and we are a little uneasy as to how long this is going to last. So I thought I would make a brief video and try to explain to you guys some of the benefits of using options in order to protect your current holdings. So stay tuned and hope you guys learned something. Okay, guys, so here we have a chart of silver, SLV. It is an ETF of silver, and it is one of the more popular stock symbols that we traders use to buy and sell silver, whether it be pure equity shares or rather it be options. We like playing the wheel strategy, which is something we cover in other videos, and we've been using silver to earn a pretty decent monthly income on it. And however, for this video, we're going to talk about protecting our investment after we've already purchased shares. So let's assume that we have owned silver for some time. Hopefully we were smart enough to get in at a low point, maybe around here or something like that. And it has gone up. We've continued to buy and sell and everything. However, as it stands for right now, we are sitting on 100 shares of silver. And in this example, our base cost is $75 per share times 100. So we're in silver for $7,500. So what can we do during times of uncertainty like now to help protect, or at least give us some peace of mind that if silver is going to keep declining as it already has started to do, and we don't know how long that's going to take or if it's going to recover, what can we do if we are already in silver for $75 a share in order to give us some peace of mind and give us some insurance so that we can minimize our loss in case we have to get out? And that is what a protective put option is for. So again, the dotted blue line here shows, I drew it out for you, we are at $75 per share. We own 100 shares. How do we protect that? And I'm about to show you. So now I'm going to open up Trader Oasis, our favorite options trading platform that we teach extensively at Options Pro Trading. And I have already opened up what's called an options chain, or a grid of silver right up here, SLV. Now, the options contracts are exactly what that is. We can buy and sell different contracts that give us different rights and obligations to manipulate shares we already own or shares that we may want to own in the future. But to help simplify for this video, we're just going to focus on using options to protect our investment during these uncertain times. One of the ways we can do that is by buying a put options contract. Now, what that is, a put options contract is kind of how it sounds. It gives us the right, once we've purchased this contract from someone else on the marketplace, it gives us the right to sell our shares at any time while the contract is in place. We can sell our shares at the price that we have negotiated on in the contract, or what we like to call the strike price. So if you think about it, we own 100 shares of silver at $75 per share. We are uncertain and we would like some insurance to protect that $75 base cost. Well, here we have a put contract that we can use. So right here on my mouse, I have the $75 strike. That is the price that we want to protect, because that's how much we currently own silver for. And we are going to go out. Let me clear this. Come on now. There we go. And we're going to go out and we are going to buy a put option contract. Now, when we buy this contract from someone else on the marketplace, and whoever it is unimportant. We're never going to know. It's an order you put out in your brokerage. It gets filled. The person on the other end not important. So in this scenario, we have gone, and in order to buy this insurance policy, it's going to cost us $10.02. Now, an options contract represents 100 shares of a stock. So even though it shows $10.02, this is actually costing us about $1,002. We move the decimal place two times. Now, what that does is this put option that we're buying, paying the $1,002 from someone else, it gives us the right, not the obligation. We don't have to use this insurance policy that I'm describing, but we have the right at any time between the time we purchase this contract and the time that it expires. And I chose for my insurance policy to expire on June 18th. When I do these kind of protective strategies, I like to go out more than 3 months because that gives me plenty of time to decide what to do. And longer the time, as long as I can afford it, of course, more peace of mind for me, and I don't really have to worry that much. Now, this one again is a $75 put options contract that expires June 18th. Cost us a little couple bucks over $1,000. And that again gives us the right to force the someone else to buy our shares at $75 per share, no matter what the price is, anytime between now and June 18th. So that means, if you think about it, silver can go down to $20 a share if it crashes or something crazy happens in the world. We don't care. We simply go to our broker, we exercise this contract, and then that will force our shares to be sold at $75 per share, exactly what we paid. We get all our money back. Now, of course, we do lose the price of what we paid for the insurance policy. Just like when you go and you purchase insurance on your car, it's not free. You need to pay money or a premium to own this insurance policy, let's say for a year. And if your car gets in an accident or you need to put in an auto insurance claim, then that's exactly what this does. It protects the value of your car. This contract protects the value of the stock. Now, Progressive, as an example, they're not going to give you a refund if you put in a claim. Whether you use the policy or not, you paid them the premium, it's non-refundable. Same thing with the options contract. So yes, if we end up exercising or having to use this insurance policy to get rid of our shares at the price we paid, we get all our money back. Yeah, okay, we do lose $1,000. But what if I told you there is a way that we can get our money back, unlike auto insurance? Well, there is a way to do that. What we've talked about so far, simply buying this put contract, this insurance policy on our shares, we call that a protective put. But now we're going to go a step further, because now what I'm also going to do is not only am I going to buy this insurance policy to protect my silver from someone else, but at the same time, I can go and I'm going to sell someone else an insurance policy. And when I sell that insurance policy, they're going to pay me. And that the money that I receive from selling that policy is going to help pay for the insurance policy for my protection. You understand? So I'm spending $1,000 to buy a protection policy from someone else, and I'm going to sell my own policy to somebody else in order to recoup some of that expense for my protection. So in this case, I'm choosing the $80 strike, and this time, instead of buying a put that costs $1,002, I'm going to sell someone else a contract that costs, let's see, costs the exact same thing actually. So if you look down here, the total price of this order is $0. So that means that, again, I purchased a put option for $1,002, like we just talked about, giving me the right, if I need to, I can use that policy and force sell my shares away to someone else. I can put them to someone else, so why it's called a put, for $75 a share, exactly what I paid, and I'm free and clear. No matter if silver, whatever price it is, now I have that peace of mind. But it cost me $1,000, right? $1,002 to be specific. But I'm also going out and I'm selling someone else a contract at the $80 strike. We call this second contract, we are selling a call. So first, we buy a put. That's what it's called. That's our insurance policy to protect our silver. And then I'm also selling a call to somebody else at 80. Now, what that means is when you sell a call, you are selling your legal obligation to sell your shares of silver in this example to the purchaser of your contract. But wait a minute, notice that it's $80 per share on this contract, and but we only paid $75 per share. That's good. We are creating a win-win scenario of peace of mind. So if you think about it logically, let's go over it nice and slow. Step one, we bought the protective put policy at $75 strike until June 18th. So for $1,002 that we paid someone else, we can force them to buy our shares at $75 per share up until June, no matter what the price of silver is trading at. And at the same time, we also went out and sold our obligation to sell our shares of silver to someone else if they choose to at $80 a share, which means if the person that we sold this to exercises their contract on us, yeah, we're going to lose our shares, but we only paid 75, they're going to pay us 80. That's a $500 profit return, which is pretty good. So if you can think about it logically, we are protecting the downside and the upside, and it's not costing us anything. So again, now we are in a position of, well, a great position to be honest with you, of up and down protection. So yes, if silver plummets, we can get out at 75 up until the middle of June, right? And if silver goes down a little bit, let's say in a month or two, it turns around, tension eases, the market goes back to bullish growth, and it starts climbing, and then silver gets to 80, 90, whatever it is, we will have to sell our shares, but at $80, which means we will be in a nice 500 plus profitable event. Now, some of the skeptics will say, yes, okay, Sean, but what you're doing is you are capping your upside. Yes, I am. Which means, let's say if silver turns around on us before June 18th and goes to 200 bucks a share, yeah, I could have made a lot more than having to force sell it at 80 bucks. I can make a lot more. However, I wouldn't have that peace of mind to protect my shares all this time. So yes, when you do a collar protection, you do give away some upside, but you gain the peace of mind. So you don't really have to worry. And the other beautiful thing about a collar is that it has a built-in speedometer of protection, which what does that mean? So if silver doesn't really go anywhere and stays still, all right, well, we don't have to use our protection, but we're in a nice place where we didn't really pay anything for this insurance policy anyway, so no harm, no foul. We keep our shares and life continues. However, if the price of silver plummets, we can get out at 75. There's our peace of mind that we've created here. And yes, if it does turn around and go back, we will force ourselves to sell at 80 bucks, which is still profitable. A profit is better than a loss. So yes, we do give up a little bit of upside, but we gain a lot of bit of protection. So that is the collar trade. There are a lot of other nuances to it that we go over with our students. We deep dive into this, such as the theta, the gamma, the delta, and a lot of other things, implied volatility, extrinsic, intrinsic value, open interest, things of that source, things of that nature. All of those answers, all of those questions are answered, and all of these strategies are taught. We are teaching right now over a dozen strategies in our classes. This is merely 1 to 2 of them that are defensive based. We have a whole lot other ones. Plus, we have a whole gamut of options, strategies that can help you purchase shares at the price you dictate instead of what the market dictates, and get paid to do so. So drop your comments. I hope you like this video. Subscribe, follow, send us a DM. We're more than happy to jump on a free video session, talk about your learning goals, and hopefully we can help you out. Until next time, Stay profitable.